If you're an active trader looking to increase the amount of money you trade with, I have urgent news. You can get $5,000 or more for your trading account. The hardest task an active trader has is to manage cash flow. Without using every technique available to earn a profit, you can quickly run out of funds to trade with. That's why Traders Accounting put together an eye-opening, easy-to-understand, 11-part video series about the business of trading. These videos cover what every successful trader needs to know, such as what business a serious trader like you needs, the best way to set up your trading business, wash sales and capital loss restrictions, business expenses you may not have thought of deducting, what mark-to-market is, and efficiently trading your own retirement money. These free videos show you how to get an IRS subsidy of $5,000 or more every year just by trading. It's easy to get our free videos too. It's quick, easy, and safe, and there's no cost or obligation. Thank you, and we'll see you on the next page.
Well, good evening, everybody. This is Steve Ribble with ShrinkMyTaxes, and I'd really appreciate you all taking the time to join us this evening to learn a little bit more about the trader tax status, and we'll jump into that in a second. I'd also like to thank Fari for hosting the event this evening. You're very generous, sir, and would like to thank Jeffrey Lynn and James Falba over at Market Heist for helping to organize this event as well. So a big thank you to all you fellows out there. Let's see. Jeffrey actually approached me this afternoon and wanted me to talk a little bit about the tax cut extension, and so I put a few things together. And I think, if I'm not mistaken, they're supposed to vote on this later this week. So this isn't set in stone as I see it. But what they're essentially going to be doing is extending the Bush tax cuts for an additional 2 years. So the income tax rates that are in place as of right now, which would be the top rate of 35%, is going to be extended out for another couple of years. Capital gains rate would stay at 15% for the max rate, and the AMT is going to be indexed for inflation. That's the alternative minimum tax. It's going to be indexed for inflation. Estate tax will be coming back next year, and the top rate there is 35% with a $5 million exemption, which I believe is what's on the table. And good news, I think, for everybody out there that draws a paycheck is going to be the payroll tax holiday. It's going to cut 2% off of that tax and put a little bit of money in everybody's pocket out there. Equates to, if somebody makes $100,000 a year, they'll see an extra $2,000 next year in their pocket. So that's always a welcome sign. I'm not sure, Jeffrey, there's any other additional questions beyond that, but from what I saw, that is what is kind of being formulated on the taxes as far as the extensions, and I think they vote on it later this week. Okay, so if anybody has any questions on that, you guys can type them in there. I'd be happy to grab those for you as well. So let's jump into trader tax status, which is what we're all here for this evening, and this is where we're going to be using the tax law to cut your tax bills. Start out with just a couple quick disclaimers and the lawyer speak, if you will. This is a presentation that's going to be for informational purposes only. It doesn't represent any specific tax advice, and I realize that everybody out there is unique, and they're going to have their own unique tax situation, so please consult with a qualified tax professional on any information that you might see here this evening. The second thing is that Hamzy Analytics and Market Heist, they don't assume any responsibility for any errors or inaccuracies or omissions in this webinar. They're just hosting the event, and they've been very gracious in doing that for me. And also realize that Hamzy Analytics and Market Heist don't provide tax advice, and none of this presentation should be construed that way as well. Okay. I'd like to start out with a quick quote, and Fari saw this today and he made a comment, but it's William Rehnquist, who was a Chief Justice of the United States Supreme Court from 1986 to 2005, and I think this kind of sums it up. And he said there's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. And I think that is what we can gather from this. Trader tax status isn't anything new. It's been on the books for quite a while, but understanding that code and using it to your advantage is where you're really going to get the benefit of cutting your tax bill every year. So the agenda today that I'm going to talk about is predominantly four things. It's going to be basics of the trader tax status and what the IRS looks for. We're going to look at the trader status benefits. So if you qualify for trader tax status, what kind of benefits are you going to see? And this is what I call WIIFM, or what's in it for me. We're going to talk briefly about entities for traders and some reasons why you may look at incorporating your trading business. And I'll finish it up with some of the frequently asked questions that I get in dealing with trader taxation. And if we have time, I think we're going to open it up for questions out there as well. So trader or investor, and Fari asked me earlier if this was a picture of me, and that gentleman there has way too much hair to be me. I'm not that fortunate, but if that is you, I apologize, anybody out there, because that was pulled off of Google Images. Are you a trader? Trader tax status, one of the problems that you'll find if you do any research on trader tax status is that the IRS doesn't offer a clear definition of what you would do to qualify as a trader. You can read their guidelines and their regulations, and it's really not defined in any specific specificity. And you'll see that here on the next slide of exactly what I'm talking about. I kind of equate it to, if you saw the movie The Pirates of the Caribbean, when they were talking about the pirate code, and the pirate's response was, it's more like guidelines. And that's really what you get from what the IRS gives you, and that's just general guidelines of what they're looking for. Most of what we know about trader tax status comes from court cases over the years. Cases like Mueller versus the United States back in 1983, where they really focused on holding periods and investment objectives. The Paoli case in 1991 focused on continuous trading throughout the year. The Frederick Mayer case in 1994 focused on actively managed accounts and deeming that as not really being actively engaged in trading if you turn your account over to a money manager. And then finally the Steffler case was another important one, which focused in on the volume or the number of trades done throughout the year. I've actually posted those cases in more detail on my website, and I'll show you that a little bit later in the presentation. But it's always good to kind of review those cases because you can learn a lot about what other people and what they made mistakes on and how not to do that for your particular situation. So let's look at what the IRS says. IRS covers traders in securities in their Topics 429, and I put the URL up there if you want to pull that off the internet and research it. But the gist of it is that they view a trader, or how they're going to view a trader, is you must seek to profit from daily market movements in the prices of securities and not from dividends, interest, or capital appreciation. In other words, you've got to be trading and not investing long-term and looking to accumulate dividends or interest or things like that. Your activity must be substantial, and you must carry on the activity with continuity and regularity. Okay, and I think you can see by that, that's exactly what they talk about, and it's kind of what I talked about. They're not very specific about what thresholds or what you have to do to hit trader status. So what do they look for? There's going to be four things that predominantly the IRS is going to look for to determine if you're a trader or if you're going to be classified and taxed as an investor. They look for typical holding periods of securities bought and sold. They look for the frequency and dollar amount of the trades during the year. They're going to look at the extent at which you pursue the activity to produce income for a livelihood and the amount of time that you devote daily to that activity. The key word there that I want everybody to take away is and, because if you miss one of those four, you're going to end up getting taxed as an investor. And what that means for you on the tax side is that you're going to lose your home office deduction. Investors cannot deduct their home office. You're going to lose investment seminar deductions. Margin interest cannot exceed investment income. That's going to get carried from a Schedule C to your Schedule A and will be subject to the AGI, 2% AGI. You're going to be subject to the wash sale rule. And more importantly, in my opinion, is that you will not be able to use mark-to-market accounting or Section 475F accounting, which we'll talk about a little bit later in the presentation as well. So some big things there. You want to make sure that you're hitting all four of those points that I talked about. So let me give you some guidelines. Excuse me while I take a sip. General guidelines for traders, and I think if you're hitting a lot of these, you're going to be okay in qualifying for trader tax status. So to run through these, a substantial portion of your liquid net worth should be used in trading the market. You should have weekly buys and sells in your accounts. Daily is going to be even better. You should have a substantial number of buys and sells spread throughout the year. I mentioned the Paoli case earlier. 71% of his trades occurred in a 4-month period. He had one trade in October in the year in question, and he had no trades in November and December. And he lost his trader case, as you can see. They didn't view him as being in the business of trading because he didn't trade for a majority of the year. What do they consider substantial? Generally, north of 500 trades for the year, you're going to be safe in trader taxation. And if you're only doing about 1 to 200 range, that's going to be very tough to hold up your trader tax status. Typical holding periods under a month. Some of the other cases I mentioned previously, their holding periods were, in one case it was 8 years in some of the stocks that they sold and tried to claim trader tax status, and that isn't going to fly in the IRS's eyes. So you need to have weekly or daily is the best trades that you're doing in your accounts. You should spend a substantial amount of time watching and trading the markets, 3 hours a day minimum. And what I will tell you, and I think if you look at the Paoli case one more time, had he actually kept a trading log or had kept a time log, because he made the case that he was actually studying the markets and he just didn't trade on those days, but he had no documentation to back that up. So if you are spending, some time daily, reviewing charts and doing other things related to the markets, reading trading books, etc., that goes in your time log, and that can help substantiate your case for trader status. And you must maintain a business-like operation. You are qualifying in a trader status. You're going to be running a business as a trader, and so that means you need to keep good books and records and keep a trading journal. That's something that I know a lot of successful traders out there do, and that's just additional documentation to back up your case for the trader status. Now, how do you elect trader status? Well, the good news is that there actually isn't a formal election. You don't have to fill in any paperwork or do anything like that to elect trader status on your accounts for your tax forms. You can claim trader status for 2010. Even if you haven't claimed it already, you can actually claim it for 2010, and you can actually go back and claim it for the past 3 years, which is years 2007 through 2009 on your tax forms. All that would be it would take is to file an amended tax return and include a Schedule C, which is a profit loss from a business, and put your expenses on that Schedule C, and then refile those tax forms, and you should get money back in most cases. So that is the good news. It's very easy to elect trader status. You can just go ahead and fill out that Schedule C. Not sure if you qualify, and if I'm not mistaken, I sent this PDF to Farah. He should have it up on the website later when this recording goes live. But you can go to my website at ShrinkMyTaxes.com and fill out the trader analysis and fax it or email it back to me, and I will review your case and let you know if you should qualify for trader tax status.